Picture this. You open your banking app, and there it is, $50,000 sitting in your savings account. You feel a massive wave of relief. You finally feel financially secure. But behind closed doors in corporate boardrooms, bank executives are looking at customers exactly like you, and they're calling you their absolute worst nightmare. They actually have a specific, derogatory name for you. They have spent billions of dollars designing a financial system just to ensure that the vast majority of people never reach that specific milestone. I spend an unhealthy amount of time analyzing the hidden mechanics of the financial industry. I read through SEC filings and internal banking strategies. I do this so that I can show you exactly how this system is rigged against you. Today, we are going to break down the perverse incentive structure. This structure makes your financial stability a direct threat to bank profitability. I am going to show you exactly why crossing that $50,000 threshold puts you completely outside their wealth extraction machine, and I will show you how you can use their own psychological traps against them. To understand why your bank secretly hates your $50,000, you have to look at how they actually make their money. Think of the banking system as a massive extraction funnel. As people move down this funnel, the bank extracts money. They do this through overdraft fees, credit card interest, loan origination fees, and minimum balance charges. You might assume that a bank's most profitable customers are the ultra-wealthy, but the math tells a completely different and brutal story. A study of 70,000 bank customers revealed a shocking truth. Almost half of all clients generate zero profit. Some actually lose money for the bank. Meanwhile, the top 1.5% of customers generate 50% of all the profits. These incredibly profitable customers are not millionaires. They are everyday people, people living paycheck to paycheck, people who frequently overdraft, people who carry revolving credit card balances and rely on high-interest personal loans. The entire system is engineered to extract maximum revenue from financially vulnerable people. It creates what is essentially a broke tax. Let me make this real for you with a quick comparison. Imagine a customer named Sarah. She makes $65,000 a year, but she lives paycheck to paycheck. She overdrafts her account a few times a year, she carries a $4,000 credit card balance at 22% interest, and she recently took out a personal loan for car repair. Sarah generates nearly $2,000 a year in pure fee and interest revenue for the bank. Now, imagine Mike. He makes the exact same $65,000 salary, but he has $50,000 saved up. Mike never overdrafts. He pays his credit card in full every single month, and he pays for car repairs in cash from his emergency fund. Mike generates zero overdraft fees and zero credit card interest. This means the bank might actually be losing money on him after paying for FDIC insurance and operational costs. In fact, the credit card industry literally refers to people like Mike as deadbeats or freeloaders in their internal meetings. They absolutely despise transactors who pay their balances in full because they generate almost no revenue. Meanwhile, revolvers who carry balances fund the entire operation. This brings us to the psychological superpower of having $50,000 saved up. When you hit that number, you completely escape the extraction funnel. You have gained total negotiating power. If your credit card company suddenly raises your interest rate and you're living paycheck to paycheck, you just have to accept it. You need that credit line to survive. But if you have $50,000 saved up, you can call them up. You can threaten to close the account and pay it off today. This completely flips the conversation. Banks exploit a psychological concept called present bias. They offer you flashy credit card sign-up bonuses. They do this knowing that you will likely carry a balance for years and pay thousands in interest. But when you have a massive cash buffer, present bias doesn't control you anymore. You can take the $500 sign-up bonus, you can pay off the balance immediately, you never pay a single cent in interest. You're effectively using their own psychological tricks against them. Furthermore, an educated saver realizes a hard truth. Keeping $50,000 in a traditional checking account earning 0.01% interest is a terrible idea. You move that money to an online high-yield savings account, paying 4 or 5%. You take your cheap deposits away from the big banks, and now they can no longer lend your money out at 20% while paying you pennies. The ultimate revenge against a system that profits from desperation is to become completely financially boring. You build that massive cash buffer. You proudly become the deadbeat customer who pays off their credit cards every month, and you automatically invest your surplus cash into low-cost index funds to build real wealth. If you want to keep outsmarting this extraction machine and learn the exact financial strategies the wealthy use to stay ahead, hit that subscribe button right now. The YouTube algorithm doesn't always favor this kind of blunt financial truth, so subscribing is the best way to ensure you never miss the strategies that actually put money back in your pocket.